All right, welcome to Intelligent Investor Insights. I'm Josh Barone, and I'm joined by my father, Dr. Robert Barone.
Folks, today's topic is, well, honestly, it feels like deja vu. These credit markets, they're acting like the Titanic has just left port. Ship looks unsinkable, the band's playing, everyone's sipping champagne. But I've seen this movie before.
And not just because he remembers the actual Titanic, by the way. But jokes aside, 2025's just staggering. $12 trillion in new global bond issuance. Governments rolling over all that pandemic-era debt. Corporations refinancing like there's no tomorrow. Even private credit, $500 billion in new loans and counting. No brakes, just pedal to the floor.
Right. And then you look at investment grade issuance in the US, record highs, over $1.3 trillion. High yield globally, strongest it's been since, 2017. And spreads are just crawling along the floor. Even the lowest rated investment grade, triple Bs, yielding barely 5%. For that much risk, it's reckless optimism. Prices say everything's safe, but you and I both know, Josh, risk doesn't just disappear because you stop charging for it.
Exactly. It's this paradox. As the system piles on more and more risk, the actual price of that risk is collapsing. You get these late cycle vibes. Everyone's trading as if calm seas mean the hull's bulletproof. Feels like, 2007 all over again. Speaking of which, you gotta tell that old story, the one from your banking days.
Yeah, those days banks were all in, buying up everything with a spread because liquidity felt endless. We saw institutions holding paper that looked rock solid on paper. Spreads were tight, nobody wanted to see the downside, and when the funding pipes suddenly clogged, panic. Couldn't price anything. The lesson's simple. Tight spreads are a mirage, and the real risks show up when it's already too late for most.
It's like, if you're underwriting risk for free, you're just volunteering to be the last passenger off the ship when it hits the iceberg. No one gets extra points for confidence if you're ignoring the cracks below deck.
Now, maybe the most surreal thing to me in 2025 is watching big tech morph into these quasi-sovereign credits. Apple, Microsoft, Meta, Alphabet, even Nvidia and Tesla, trading within 100 basis points of treasuries. It's like the market says, these guys are safer than most countries.
Yeah, and everyone's crowding into the Magnificent Seven, thinking fortress balance sheets mean zero risk. But when perfection is fully priced in, where's your cushion when anything goes wrong? Like, say, a hiccup in AI or energy prices spike. That's a lot of safe money radiating out from a single, very crowded corner.
And the new industrial revolution, all this AI infrastructure, it isn't coming cheap. You've got that Meta Blue Owl Hyperion deal, $27 billion for a Louisiana data center, most of it financed through private credit. Looks neat on Meta's books. They lease it back, keep the debt off balance sheet. But the leverage, it just moved next door. Reminds me of, what Enron pioneered ages ago, special purpose vehicles to shuffle leverage out of sight, but definitely not out of the system.
That's it. Risk hasn't disappeared, it's just gotten better at hiding. A client asked me last week, these private credit funds promise high yield and barely any volatility. How is that possible? The short answer? It isn't. You got covenant light agreements, so distress signals are suppressed. Then you pile on leverage inside leveraged entities and price the paper to whatever model you want. The mark to model thing is like putting on rose-colored glasses, then swearing the world looks pink.
Exactly. Investors are accepting wafer-thin premiums for opacity and illiquidity, spreads that barely compensate for the risks bubbling under the surface. You call it ballast, but as we know, when the ship starts to tilt, that ballast turns from stabilizer to wrecking ball pretty quick.
And I'm seeing it firsthand. Private credit's marketed as high yield, low vol, the magic combo. Like enjoying first class on the Titanic until you realize the so-called design flaws aren't above deck, they're below. There's nothing new under the sun, just a better sales pitch each cycle.
And a world that keeps forgetting the consequences. We've shifted the leverage, layered on complexity, but we're not any less exposed. If anything, the illusion of control is more seductive now. When funding costs jump, or when those innovative structures lose favor, the safety unravels, with a lag but all at once.
Let's shift gears, because while long-term credit still looks on the surface pretty tranquil, there are warning signals blinking everywhere you actually bother to look. Look at funding markets. SOFR is now separated from the Fed funds rate by almost 10 basis points, biggest gap since 2020. A couple of basis points may sound trivial, but like you always say, Dad, it's the direction and persistence that matter, not just the number.
Right. That SOFR Fed funds divergence says balance sheets are strained, issuance is overwhelming dealer capacity, and repo markets are itching for relief. It's the same cocktail we saw in the lead up to both the 2007 crisis and the 2019 repo crunch. Add fiscal dominance, Treasury has to refinance $8 trillion soon, deficits running north of 6% of GDP, and you've got the perfect setup for a supply-demand mismatch. Liquidity can look fine on paper until suddenly it isn't.
And you see it in the real data. More than $40 billion downgraded from investment grade to junk so far this year. The biggest fallen angel wave in over a decade. But look at those Bloomberg investment grade indices, still hugging record tights. It's classic late cycle psychology. Oh, it's just idiosyncratic. Yeah, that was the script about subprime too, right before things got messy.
Exactly. Recency bias is running wild. It's always the same excuse. One cycle, it's subprime is contained. Next, inflation is transitory. Now, AI will outgrow the debt, as if innovation has ever permanently outpaced leverage. All you have is an increased willingness to look away from clear fragilities. The Fed always seems to call these things technical until they become systemic.
And the repricing, when it comes, moves fast. Investment grade, high yield, and then last and hardest, private credit. Like you wrote, liquidity is not capital, it's confidence. And confidence is always the first casualty.
That's the iceberg. Everyone sees the calm surface, but when spreads widen, and they will, the illusion disappears quickly. The question isn't if the ship hits trouble, it's who's left on board. I guess to wrap us up, remember folks, just because everyone's crowding the deck doesn't mean the hull is sound. Discipline is still the only real lifeboat.
Couldn't say it better. Thanks for riding along with us today. If this felt a bit gloomy, well, it's better to spot the iceberg before you're taking on water. We'll be back to dig into equities, liquidity traps, and whatever else Wall Street tries to sweep under the rug next. Until then, stay smart, and Dad, try not to sink any ships while I'm gone.
I'll do my best, son. Take care, everyone. Thanks for listening, and we'll see you next episode.